Key components of funds transfer pricing, FTP, in bank treasury management. Funds transfer pricing, FTP, is a critical tool used in bank treasury management to allocate costs and revenue across different business units. It provides a mechanism for measuring and assigning interest rate risk, liquidity risk, and other fund-related risks within the bank. In this video, we will explore the key components of FTP. 1. Cost of funds. The cost of funds represents the interest expense incurred by the bank when borrowing money from external sources, such as depositors, or borrowing in the interbank market. This cost reflects the interest rate paid on these funds, taking into account factors like tenor, credit risk, and market conditions. 2. Risk-free rate. The risk-free rate serves as a benchmark for pricing different assets and liabilities within the bank. Typically, it is based on government bonds with a specific maturity, such as Treasury bills or bonds. The risk-free rate helps in assessing the expected return on investment and determining the pricing for various funding sources. 3. Liquidity Premium. The liquidity premium is the additional compensation required by the bank to hold liquid assets or liabilities. It accounts for the risk associated with the potential difficulty of converting these assets or liabilities into cash without incurring substantial losses. The liquidity premium is assessed based on market conditions and the bank's own liquidity profile. 4. Term premium. The term premium reflects the additional compensation demanded by investors for taking on long-term financial commitments. It captures the risks associated with interest rate fluctuations, inflation, and potential changes in the economic environment. Bank treasury management considers the term premium when setting pricing for long-term assets and liabilities. 5. Credit spread. The credit spread represents the additional interest rate charged to borrowers to compensate for the credit risk associated with lending. Banks consider various factors when determining the credit spread, including the borrower's creditworthiness, collateral, and the prevailing market conditions. This ensures that the bank is adequately compensated for the risk it assumes. 6. Operational costs. Operational costs are the expenses related to running the treasury and funding operations within the bank. These costs include staffing, technology, infrastructure, and other overhead expenses. FTP allocates these costs to different business units based on their utilization of funds and other resources. 7. Profit center attribution. Profit center attribution assigns profits or losses to specific business units based on their contribution to the overall returns of the bank. FTP helps determine the profitability of individual units by factoring in their funding costs, risk metrics, and performance indicators. This enables a fair and transparent assessment of each unit's profitability. Funds transfer pricing is an essential tool for bank treasury management, as it provides a comprehensive framework for pricing and managing funds across the organization. By considering factors like the cost of funds, risk-free rate, liquidity premium, term premium, credit spread, operational costs, and profit center attribution, banks can make informed decisions regarding their funding sources, interest rates, and overall profitability. Want to learn more? Claire Trithel on LinkedIn